So if changes in the market prompt you to sell some investments for more or less than your adjusted tax basis in the asset, it may result in capital gains or capital loss. Hopefully, your reason for selling are consistent with your overall investment strategy and not emotional reaction to short-term market swings. Otherwise, you might be selling when prices are falling and buying when prices are rising, which is the opposite tack from the recommended buy low, sell high strategy. So short-term capital gain, which is profit on investments held for 12 months or less, are taxed as ordinary income. So if you're in a 24% tax bracket, you will pay 24%. Long-term capital gains, profits realized from the sale of an investment that were held for more than 12 months, receive a special tax treatment. The top long-term capital gains tax rate right now is 20% for high-income investors, but most investors pay 15% on long-term capital gains. If your capital losses exceed your capital gains for the year, the excess can be deducted on your tax return and used to reduce other income, such as wages, up to an annual limit of $3,000 of ordinary income per year, or $1,500 if you are married filing separately. And if your total net capital loss is more than the annual limit on capital loss deductions, you can actually carry over the unused portion to the next year and treat it as if it incurred in that year. So here's a hypothetical example. Sam had $4,000 capital gain last year, but his capital losses totaled $10,000. He can apply $4,000 of the losses to offset all of the capital gains, and he can also apply $3,000 of the losses against his ordinary income. The remaining $3,000 losses could be carried forward to the next year for him to use. If you sell a security at a loss and repurchase a substantially identical security within 30 days, before or after of the sale, the IRS will disallow the loss for tax purposes. This is referred to as wash sale rule. As I mentioned, the tax code treats long-term capital gains more favorably than ordinary income, such as wages or interest from bonds and savings accounts. Qualified dividends, which is profits paid to shareholders from domestic corporations or qualified foreign corporations, receive the same tax treatment as long-term capital gains. Non-qualified dividends are taxed as ordinary income, just like short-term capital gains, which are profits on investment held for 12 months or less. So in order for you to make sound investing decision, it's important to understand how your investments will be taxed. In 2021, long-term capital gains and qualified dividends are taxed at 15% for the single filers whose taxable incomes range from $40,401 up to $445,850. And for married joint filers whose taxable income ranges from $80,801 up to $501,600, lower income filers pay zero tax on long-term capital gains and dividends. Higher income filers, by the way, which are single filers with taxable income exceeding $445,850, and married joint filers with taxable income exceeding $501,600, pay 20%. Generally, dividends on stocks that are held for at least 61 days within a specified 120-day period are considered qualified for tax purposes. Distributions from mutual funds held in taxable accounts are also taxable to shareholders. By the way, the taxable is long-term and or short-term capital gains dividends or interest for the year in which they were received, even if the distribution is reinvested in new shares. In addition, some high-income taxpayers may be subject to 3.8% unearned income tax or net investment income. Capital gain dividend interest, royalties, rents, and passive income, if their modified adjusted gross income, AGI, exceeds the $200,000 threshold for a single filer and the $200,000 threshold for joint filers, the 3.8% rule net investment income tax applies to the lesser of A, net investment income, or B, AGI exceeding the threshold. It does not apply to withdrawals from IRAs and qualified retirement plans, nor does it apply to municipal bond interest. The money you contribute to tax-deferred plans, as well as any earnings, will accumulate tax-deferred. When you buy or sell investments within your plan, there are typically no tax implications, by the way, subject to plan rules. You won't owe any income tax until you withdraw money from the account, at which time you will be taxed as an ordinary income. Generally, it's not a good idea to take advantage of tax-deferred savings plans whenever possible. Up to a specific annual limit, you can make pre-tax contribution to an employer-sponsored retirement plan and or make tax deduction contribution to a traditional IRA, which could lower your taxable income in a given year. Tax deferral has the potential to boost your earning potential because you have full contribution working for you. To illustrate, take a look at the hypothetical example. The chart here shows potential growth in account value at $5,000 annual investment in taxable and tax-deferred vehicle earning a hypothetical 6% rate of return. After 40 years, the money placed in the taxable account would be worth $567,680. During the same period, the tax-deferred account would grow to $820,238. That's significantly more than the taxable investment. Even after taxes have been deducted, assuming lump sum payout and 24% tax rate, you would still receive $623,381. You also might consider whether an annuity could play a role in your retirement investment strategy. You see, purchasing an annuity could help boost your income and reduce your risk of depleting your savings in retirement. And knowing that some of your retirement income is protected might enable you to invest a portion of your portfolio more aggressively. See, an annuity is a contract between you and an insurance company in return for premium payments you make during the annuity accumulation phase. The company pays you regular income during the payout or annuitization phase, usually during retirement. Immediate annuities pay income right away, while deferred annuities start paying at some future date. Annuities also offer tax benefits. Investment earnings are basically tax deferred until withdrawals are received. But unlike the caps placed on the IRAs and employer-sponsored plans, there is no federal contribution limit for annuities. This means that you can suck as many after-tax dollars as you want over time, or on an annuity with a lump sum from inheritance or the sale of a home or a business. When you retire, payouts can be structured to provide you with an income stream that is guaranteed to last throughout your lifetime and or the lifetime of your spouse, much like a pension. This may help alleviate any fears of outliving your savings once a contract annuitized and those guaranteed payments kick in. However, control of the assets transfers to the insurance company. For this reason, some annuity owners never annuitize their accounts, choosing to take withdrawals as needed instead. This will allow any remaining asset in a deferred annuity to be left to the heirs upon death. Now that we've discussed a few of the most common types of investment, let's look at some of the fundamental investment tactics that could enhance your potential for financial success in any market environment. 3 fundamental investment tactics are suggested to help you manage risk, smooth out investment returns, and improve the potential performance of your portfolio over the long run. Although these strategies may seem unexciting, much of their value comes in from reducing the potential to react emotionally during periods of market volatility. They are diversification, asset allocation, and dollar cost averaging are the methods used to help manage investment risk. Keep in mind, they do not guarantee a profit or protection against investment loss. Let's start with diversification. It involves investing in different investment vehicles in an attempt to limit exposure to losses in any one sector of the market. Different types of investments may react to changing market conditions in different ways. For example, an unfavorable news story may push stock prices lower while bond values rise, or vice versa. When you divide your money among various asset classes and investment vehicles, gains in one area can help compensate for the losses in another, and thereby limiting your risk of loss. And although any level of diversification can help protect a portfolio, it can be hard to determine which type of investments are most likely to react differently when market volatility occurs. That's when a financial professional may be of help to suggest a mix of investment opportunities for you that can perhaps enhance the benefit of diversification. Of course, there are no assurances that working with a financial professional will improve investment performance, and diversification is a method used to help manage investment risk. It does not guarantee profit or protect against investment loss. So keep that in mind. Now, because stocks tend to be more volatile than other investments, here are some possible ways to diversify the equity portion of your portfolio, whether you're investing in individual stocks, individual funds, or exchange trading funds. You could, for example, divide your equities among large cap growth and value stocks, small cap growth and value stocks, dividend yielding securities, international investments, low volatility funds, even among different industry sectors. Market capitalization is a measure of the company's size and value. Large caps tend to be more stable and thus have less growth potential, while small caps tend to be more volatile in terms of growth potential and risk. The terms growth and value reflect different investing styles. Growth companies typically do not pay dividends and are more likely to reinvest their profits. Investors hope to benefit from future appreciation. Value stocks may be priced lower relative to their earnings assets or growth potential. Good stocks and value stocks and large cap and small cap stocks may all respond differently for different market conditions. Dividend yielding securities provide income that can be reinvested or used to supplement other income, making them attractive to conservative investors. The total return from dividend stocks comes from the dividend reinvested plus any price appreciation. Now, a Standard & Poor's study found that dividends have represented 1/3 of the monthly total return for the S&P 500 index since 1926. Dividends are also fairly stable over time, and during periods of volatility, dividend income can provide some protection when prices are falling. Now, international stocks may perform differently than domestic stocks, creating the potential for growth at times when the US market is declining. Of course, investing internationally carries additional risks such as difference in financial reporting, currency exchange risk, as well as economic and political risk unique to the specific country. Any of these factors could create greater share price volatility, and you might consider investing a portion of your equities in low volatility stock funds and ETFs in an attempt to capture reasonable returns with less risk. And although low volatility funds may provide downside risk protection, they might not provide as much upside performance potential in certain market conditions. Remember, diversification is not a guarantee of a profit or to protect against loss. It is a method you could use to help manage risk, and the return and principal value of stocks and mutual funds and ETFs fluctuate with market conditions. Keep in mind, asset allocation involves strategically dividing a portfolio into different asset categories, typically stocks, bonds, and cash alternatives. You do that to seek the highest potential return at a particular level of risk. History has shown that the best performing asset classes often change from year to year. Stocks may generate the highest returns in some years, whereas bonds may outperform stocks in others. So during bear market, cash alternatives may be higher performers. In and of itself, asset allocation is easy. In fact, whether you know it or not, your assets have been allocated, perhaps in a single stock, in savings account, in a mixed portfolio, or under the mattress. However, finding an appropriate mix of investments for your risk profile, financial needs, and time frame is more difficult. It may require careful calculation and the benefit of professional guidance. If you want to personalize your asset allocation, you need to take into account your investment objectives. Whether you're concerned about protecting the value of your portfolio, looking for growth potential, or generating steady income, your time frame and your risk tolerance, asset allocation does not guarantee a profit to protect against investment loss. It is just a method used to help manage investment risk by itself. Investments seeking the potential for higher return carry an increased level of risk. If you receive a statement from a mutual fund company or a 401k plan, you may see a breakdown of how your fund assets are allocated in the form of a pie chart. This pie chart you see shows a hypothetical allocation for a conservative investor. This investor's primary concern is to minimize the upward and the downward swings in the portfolio. He basically desires an appropriate mix of investment categories for such a time frame. He might have 50% in his portfolio in bonds, 30% in stocks, and 20% in cash alternatives. These investment categories would be somewhat volatile over the years, but because he has fairly long time frame, this mix of investments could give him an adequate potential return for the risk he's willing to take. How did this conservatively allocated portfolio perform over the 20-year period from 2001 to 2020? Well, during the best year, his portfolio would have earned 18.79%. During the worst year, it would have lost 11.98%. The average annual return was 8%. Now, an aggressive investor is willing to take more risk and accept more volatility in exchange for higher growth potential. She has the same 20-year time frame as a conservative investor, but her investment allocation looks different. An appropriate investment mix for an aggressive investor might be only 5% in cash and alternatives, 20% in bonds, and 75% in growth-oriented stocks. So here is how the aggressively allocated portfolio would have performed over the same 20-year period. That is 2001 through 2020. During the best year, it would have performed 27.8%. During the worst year, it would have lost 27.4%. The average annual return was 7.05%, slightly higher than the conservative portfolio. Because aggressive investments are typically more volatile, they have the potential to produce higher highs and lower lows than counterparts with accompanying risk. However, investors who are willing to wade through the market ups and downs also may achieve higher average returns over time. The third investment strategy I want to discuss with you is dollar cost averaging. Dollar cost averaging involves investing in set amounts of money at regular intervals, such as on a monthly basis. By investing the same amount consistently over time, you're able to buy more shares of an investment when the price is low and fewer shares when the price is high, which may result in lower average cost per share, regardless of whether the market is going up or down. If you're contributing a percentage of your salary to an employer-sponsored retirement plan, you're practicing dollar cost averaging. In this hypothetical example, an investor uses dollar cost averaging to invest $200 per month in a mutual fund with fluctuating share prices. At the end of 5 months, she has purchased 215 shares. As you could see, the average price per share during the 5-month period was $5.20. But because she purchased more shares when the prices were low, her average costs were $4.65 per share. So dollar cost averaging can help you take advantage of the stock market fluctuations without the stress and risk of trying to time the market. It is also a good way to steadily accumulate shares to help meet your long-term goals. Although a dollar cost averaging can be a useful strategy, it does not ensure a profit or prevent loss. To take full advantage of the benefits of the strategy, you must financially be able to continue making purchases through periods of high and low price level. So now that we've discussed investment vehicles and portfolio strategies at some length, let's look at some few other considerations that might help you put this information together. What can we learn from historical investment performance? A lot? Nothing? More than you want to know? Although past performance does not indeed tell us nothing about what will happen in the future and not a guarantee of future results, it can be instructive to see how different types of investments have performed over time and in different economic conditions and investment climates when making investment decisions. This graph shows the volatility of stocks, corporate bonds, and treasury bills from 1996 through 2020. As you can see, stocks are much more volatile. That is why most experts suggest investing in them only when you have at least 5 to 10 years before you need the money you invest. On a historical basis, corporate bonds have not performed as well as stocks over time, but they're typically less volatile on the other hand. Treasury bills and other cash alternatives almost always produce positive returns, but their potential for growth and keeping pace with inflation is much lower. If you're investing in short-term goals, such as college or the purchase of a home, you may want to keep some of your assets in lower risk and less volatile investments so you can help protect your principal for that particular goal. It is also important to consider the unpredictability of the financial markets over different time periods. Look at these cumulative returns of the S&P 500 Composite Stock Index over 3 different 5-year periods: 1996 to 2000, 2006 to 2010, and 2016 to 2020. As you can see, these 3 5-year periods produce vastly different results. Investing in stocks over short time periods could result in loss and even negative cumulative return. This occurred during the 5-year period from 2004 through 2008, when the cumulative return of the S&P 500 was 10.47%. So stocks are risky, right? But what could happen to your portfolio if you decide to take time off from investing in the stock market? Trying to time the market by moving in and out of stocks, bonds, and cash alternatives is usually a losing game and generally lowers your investment performance. During the period from 1991 through 2020, the average annual return of stocks was 10.7%. If you had held a stock portfolio that mirrored the S&P 500 for all 360 months during that 30-year period, you could have earned a 10.7% average annual return. If instead you had tried to time the market and as a result missed the 12 best trading months, your average annual return for that 30-year period would have been reduced to 7.23%. And the more good trading days you missed, the lower your return would have been. Adjusting your portfolio to capitalize on long-term trends can be beneficial. Also, missing the worst trading days would improve your overall return. But in the long run, consistently predicting the best times to buy and sell is impossible. It's very unlikely you would have picked those 12 great months at the time they occurred. A consistent long-term strategy may be more effective at helping you reduce risk and achieving your financial objective. In spite of our good intentions, some common behavioral tendencies can stand in the way of making sound investment decisions, especially when markets are volatile. Behavioral scientists, by the way, have identified cognitive biases that may cause us to ignore fundamental and critical factors and possibly focus on other information that may not be as important. Clearly, normal emotions can drive hasty decisions that could harm the long-term performance of your portfolio. So here's just a few examples of behavior you might want to understand and avoid. Confirmation bias. People have a natural tendency to come to a conclusion and then gather data to validate that decision, rather than first evaluating data before coming to a conclusion. So one way to overcome confirmation bias is to seek outside counsel from someone who can provide a different and unbiased perspective. The other one is chasing performance. Some investors may be tempted to move a lot of money into asset classes or individual investments that have had the highest recent returns. The problem with this approach is that the past performance doesn't guarantee future results, and today's hot pick could turn into a loser when conditions shift. Another one is reacting to headline news. By the time the average investor learns about economic developments or other events that could affect individual investments and the financial markets, it is usually too late to respond effectively. In fact, it's very likely that the news is already reflected in the prices of securities, and following the pack may not actually be the wisest choice you can take. In fact, following someone else's lead instead of using your own judgment could land you in trouble. Another one is loss aversion and panic selling. When investors pull out of investments or the market because they're afraid of losing money, as opposed to evaluating company fundamentals, they often end up selling at the worst possible time and buying again at the highest prices, when that is after the market recovers. By selling low, of course, they could lock in their losses, and it may cost more to get back into the market in that particular case. So managing your emotions and expectations can be difficult in any market situation, but focusing too much on short-term gains or losses is generally unwise, and abandoning sound investment strategy in the heat of the moment could be detrimental to the long-term performance of your portfolio. Do you find yourself chasing winners, or are you a value investor seeking bargain? Do you often take large investment risks for a quick gain? Or do you generally leave your investment alone for the most part? Legendary investment, by the way, Benjamin Graham, considered father of the value investing, once said the individual investor should act consistently as an investor and not as a speculator. These are words of wisdom. Capture fundamental concepts that might help you establish and maintain a sound financial strategy. Paul Samuelson, who won the 1970 Nobel Prize in Economic Science, described a patient investing approach in humorous terms. Investing should be more like watching paint dry or watching grass grow. Speculators typically take large risks by trying to anticipate future price movements in the hopes of making quick gains. The danger of this approach is that few people have the expertise, time, and resources to do that successfully. It's more likely that by trying to time the market, you will sell at the bottom and buy at the top. They might miss some of the best trading days, and their portfolios will likely underperform. Smart investors take risks too, but they buy assets that appear to be sound investments and build them into a balanced portfolio that is appropriate for their goal, time frame, and risk tolerance. In other words, they generally maintain a buy and hold strategy and invest for the long term. When it comes to your personal finances and your investment portfolio, are you where you want to be? Are you confident that you have positioned yourself to potentially benefit from changes in the economy and the financial markets? Today's presentation is intended to be the first step in the process of helping you become smarter about your money and investments. Continuing your financial knowledge will further help you make important decisions to make the most out of your money and investment. But some people may think they lack the knowledge, discipline, motivation, or time to stay on top of their finances, and the markets year in, year out. One strategy is to work with the right financial professional. Why consider working with the right one versus anyone? It's not to get rich quick. In fact, there's no assurances that working with any professional will result in you reaching your financial goals or achieving superior investment results. Professionals don't have a magic wand. However, the right one can provide education and make suggestions that you might find helpful when developing a game plan and weighing specific financial opportunities. By helping you balance your goals with market conditions, Confidence Wealth can help you determine which strategies may be appropriate for you based on your financial situation, appetite for risk, and time frame. A financial reality check might prepare you for changing market conditions. Confidence Wealth can also serve as a knowledgeable sounding board and provide you with objective viewpoint as you weigh investment opportunities and pursue your long-term objectives. We covered a lot of information today. I believe that the material we shared will help you feel more confident when you're making decisions about your financial future. So how can you put all that knowledge to work? There are several ways to proceed. You can do it yourself, which could be tremendous amount of work, or you can work with Confidence Wealth. You can also procrastinate, that's easy, but given the long-term ramifications of the decisions you must make, procrastination is not a prudent move. So I hope you enjoyed our webinar, Surviving Market Swings. As you can see, investment planning is just one piece of the comprehensive financial plan, and all components are intertwined. They all affect each other. It may be a while since we've met. If you haven't scheduled anything, take advantage of that office hour. Let's see if your investments, among other financial planning needs, can be addressed and looked into to create a roadmap for you. We will go again and look at your tax planning, investment planning, estate planning, your generational planning, your legacy planning. There are a number of issues you probably haven't been thinking about. Or if we talk to you about it, you probably weren't considering, but you're considering now. All these things can be addressed when you are at this office hour, and see if there's something that can help you achieve a better future.